Trading success, it's not just about loading up your charts with all these different indicators. It's about understanding what really drives price. Now, many traders do fall into the trap of over relying on lagging indicators, like the Bollinger Bands, moving averages. So consider this scenario. By the timing a moving average crossover signals a buy, for example, the price is already moved pretty significantly. Look at a rapid market decline, the MACD. It might only signal a sell after price has dropped 5%. Now that's far too late to enter a position, especially for effective position management. And you also have to be aware of mean reversion taking place. So these delayed responses, they create a cascading effect of opportunities that you miss. Look at the classic example of Bollinger Bands. When volatility it increases, price will frequently bounce between the upper and lower bands. It triggers these trades that don't go anywhere, and it traps them in losing positions. And we've all seen those whipsaw patterns. We probably got stuck in them, where price just keeps on crossing that middle line. It just leads to multiple stopped out trades. But here's where successful traders are different. They understand the power of supply and demand zones. Now, these are not arbitrary lines on a chart, right? These are areas where major market participants made significant decisions. Think about a stock that repeatedly finds support at 50 bucks. Well, it's not a coincidence. It's these big buyers that are stepping in with substantial orders. So to identify these zones, you just want to look for areas where prices made a sharp reversal, a sharp move in the past. So if a stock drops from $60 to $52 in one sharp move, then it bounces strongly, that $52 area has become a significant demand zone, but so does the 60 zone. That becomes something too. That becomes a supply zone. That's where the selling came from that caused that big drop. So these zones are going to act as magnets for future price action, and it could increase the probability of your trades working out. And while focusing on these zones is pretty important, indicators are still going to play a role in your trading, and here's why. These provide objective data points. These can confirm or they can challenge whatever analysis you have of the supply and demand zones. So let's look at the RSI. This can help you identify overbought or oversold conditions within these zones. That potentially increases the probability of a reversal. They can also offer an insight into market momentum and trend strength. The average directional index, the ADX, that doesn't predict direction, but it does measure trend strength. And that can be useful when you combine it with your supply and demand analysis. Volume indicators, they complement price action by confirming the strength of moves into or out of key zones. Unusually high volume at a support level, if it's indicating buying, that's a good sign. It's going to reinforce your assessment of that particular zone. And indicators, these can help you in timing your entries and your exits. And no, you should never rely only on an indicator. Tools like the stochastics oscillator, well, this can help refine your entry points within identified zones that can potentially improve your risk to reward ratio. But if you want to use crossovers, besides the obvious crossover and pullback, think of the 10 and 50 EMA crossover. So in order for the 10 EMA to cross the 50, what do you need? You need a big move in price. So if you can find those crossovers and then look for a consolidation or where a big move started around that crossover, but you found a price zone that could potentially hold more buying or selling interest. Just extend lines from those points into the future and watch those areas. Indicators are most effective when you use it in conjunction with a solid understanding of structure of the market and price action. And they should always be a complement, not a replacement of your analysis of supply and demand zones. So let's see how we can use a practical implementation of this. Start by looking at your charts with swing highs and swing lows. So these are foundational reference points, but I want you to look to the left or the right of those. And I want you to find a lower swing point when we're looking at swing highs or higher ones at swing lows. These are inner zones, and these are generally faded long before the actual extreme points. So when price approaches a previous swing low and volume is declining, well, that often indicates a potential demand zone. The key is you got to wait for some sort of confirmation through a candlestick pattern, a bullish engulfing pattern, a demand zone. It's going to carry a lot more weight than one in the middle of nowhere, for example. And for precise entries, develop what we call a change of character analysis. So this means identifying when price behavior shifts from a normal pattern. So let's say it's stock typically pulls back 20 to 38% before continuing its trend. Well, a 50 or 60% pullback, well, that's a different thing for this particular instrument that could signal a genuine reversal building up, or at least a consolidation. Even using trend channels can help you find these change of characters. Now, these are subtle differences, right? If you can find them, you will often find that these precede major moves. So here's a framework. Identify major supply and demand zones on higher time frames, just like we talked about earlier. Go down to a lower time frame for your entry. Look for 3 to 5 times lower from your higher time frame. Look for a candlestick confirmation, a pattern like a pin bar or golfing candle, even a inside bar break to the upside for longs. Look for those to form around these zones. You can even use the hook of a 310 oscillator for an entry trigger. Look for the fast line hook. And what this does mean is at least short-term momentum is in your direction. Your stop loss, place it below the zone itself, not just at some random level. And risk management actually becomes clearer with this approach because instead of hoping for the best with a 1-to-1 R to R ratio, which is not bad, 1-to-1, you're generally always going to get those. You can target 2-to-1, 3-to-1, or better. Why? Because you're actually entering at levels that matter, where big players are or were active. That increases the probability of a strong move in your favor. It's not guaranteed. So your immediate task is really wipe out all those indicators in your charts if you have a whole lot of them. Just mark the last 3 months of swing highs and swing lows. Look inside of those. Identify areas where price made some sharp moves. Well, these are your new trading zones. And then practice recognizing candlestick patterns at these levels. Don't trade yet. Paper trade, at least until you get used to this method. Even look for those oscillator hooks for your entries at these zones. Now, it's not about predicting the future. We can't do that. But we can absolutely align ourselves with the market forces that have repeatedly demonstrated their influence on that particular instrument and where. When you focus on these supply and demand zones rather than just looking at indicator crossovers, you're actually trading with the bigger money, not against it.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review NetPick's full risk disclaimer and privacy policy.